Good morning, everybody. Thank you all for coming. We have a packed house here. I'm excited about that. I appreciate everyone coming this morning, all the time you've taken. I know some of you have come from out of town or out of state, so we appreciate that. We have a spectacular panel today, and we're really fortunate for all the panelists who have come, so thank you very much. They're some of the best and brightest in the industry, ones who I've personally learned from for many years. So I want to jump right into it. Let me start by saying I've already cautioned them. No one is allowed to pull Elon Musk. If you want to smoke or drink anything, you wait until happy hour. That's what it's for. So let's jump right into this. My name is NoahMiller. I'm the Vice President of Acquisitions and Finance at Pensam Capital. We are a private local real estate group based right here in Brickell. We have investments in approximately 30,000 apartment units throughout the country in a couple of different programs. One is a direct ownership program where we own and operate. Another one is a preferred equity mezz program where we partner with sponsors. We also have a bridge program as well as a development group. But let's get started. So I'll let the panelists introduce themselves. Denny, if you want to start.
Yeah, hi. Hello. Hi, I'm Denny in Romain. I run JLL's capital markets platform in Florida.
How's it going? We there? There we go. Good morning. Chad Musgrove here at Hunt Real Estate Capital. My co-head our Miami office here. Sure all of you know us, agency lender, bridge, and balance sheet lender as well.
Thanks, Chad.
Good morning, I'm Sackley. I'm with Cushman and Wakefield, and I lead most of our institutional sales on the apartment front in the Tri-County region.
Good morning, my name is Michael Sommers. I manage the Florida office for Company Grand Peaks Properties. We're an integrated owner-manager of apartment communities. Nice to share the stage with these guys. Even last year I closed a deal where Zach was the broker selling us Club Prado, a new 8-story mid-rise property on the west side of Coral Gables, and Denny's team at JLL was our lender, so it's nice to be in the room with these guys today.
We just got to get Chad involved in the next one.
Absolutely. We talked about that.
Well, thanks, guys. And let me start also by saying, if anyone from the audience has any questions or comments during the panel, feel free to chime in. We want this to be as interactive as possible. The panelists are happy to answer questions or debate if there is any. But let's start with Michael. I've known you for a long time, and you are probably one of the most creative buyers and owners out there. And I know that from our perspective, it's been extremely difficult to buy, as well as a lot of people in the room. I know everyone bangs their head against the wall, trying to figure out how to make deals work. You have been probably one of the most, if not the most prolific buyer in South Florida over the last 18 months. So how is it that you are making deals work in South Florida, and how do you justify these prices?
So I think when I look out and drive around South Florida, I really see us buffered by the ocean and the Everglades, and there's not much space in between. And so if we're going to go out and look for a 15-acre tract of land where you can build garage-style apartments, you're going to have to be taken out of a car dealership and a shopping center to put up that product type. So when we get an opportunity to go buy 200 or 500 units that were built 20 or 30 years ago, we're looking at those opportunities and saying, we think those are rare assets to be able to own. And I think part of what people have gotten spoiled by in the last 50 years is spoiled by space. One fact that I think will surprise you guys is the population of Manhattan today is 1 million people fewer than a century ago. How is that possible? We see much bigger high-rise in Manhattan today than there were 100 years ago. It's because when you think about a one-bedroom apartment in Manhattan, $3,000 a month, that's pretty expensive. Well, if you ask somebody 100 years ago, who lives with you in your one-bedroom apartment, they're going to say my grandmother, my sister, my husband, and my 2 kids. That's 6 people were living in a one-bedroom apartment. That we've gotten spoiled by having 2,500 square foot houses. So of the 3 deals I've done the first half of this year, around $180 million to acquire nearly 800 apartments, 88% of those units were 2- and 3-bedroom apartments. Those are where families can live. Those are where roommate situations with 2 incomes can live. And they're not necessarily big units, 1,000 square foot 3-bedroom. I'm very bullish that I get $2 a foot for a 3-bedroom, even if it's in the suburbs, built in the 80s, it's smaller, fundamentally because population continues to grow. There is not land in South Florida to build many new apartments, and if you're going to go up and build high-rises, they're quite expensive. So we've been able to find value, we believe, by owning these assets and working to reposition them.
Mike, can you give an example of a couple deals that you've purchased over the last few years, or the last year maybe?
Sure. So I think when we look at buying deals, we're looking at manufacturing value. We're not simply trading an asset, but we're actually underwriting a comprehensive business plan of spending $12,000 to $25,000 per unit fixing it. We're not looking to just fix a few light fixtures, put in new appliances, and think that we've done our job. We bought a deal called Rio in the Fountainville neighborhood just south of Doral. What do I love about Doral? 150,000 people work in Doral every day. There's only 50,000 people who live in Doral. New stuff is being built in Doral, but it's being built at a very expensive price point. When we had an opportunity to buy nearly 300 apartments, a block south of Doral that was built in the 1970s. Other buyers in South Florida say 1970s, that's so old. If you go to London, if you go to Boston, that's virtually new. Properties that were built in the 1920s in Boston have been renovated 2 or 3 different times. We're willing to undertake a business plan of going in and doing a full renovation. Not just putting in new cabinets, new flooring, new appliances, but going in there and doing things that are a little bit more complicated. Like putting in all new air conditioners. There's no way to piss off a Floridian more than in the month of June and July to not have their air conditioner work. So we'll go and spend $2,000 or $2,500 a unit putting in new air conditioners, putting in new water heaters, doing things that are structurally going to make this property a much newer vintage asset and allow us to own it for 5, 15, 20 years and know that it's really going to be taken care of because of the work that we're doing to it.
Got it. You make an interesting point about manufacturing value add. We'll get back to that in a moment. But I want to speak to Zach for a moment. Obviously, as Michael's been prolific, but a lot of people have stopped buying in South Florida because they haven't been able to. Tell me a little bit about investor appetite in the market. Has there been a slowdown because prices have been higher, or have people been as voracious as over the last 3 years?
I would say, the kind of the velocity and the appetite has been consistent, is the word I would use. I think if you look at the sales history over the last couple of years, we've been kind of about a $3 billion market on the institutional side, and that's kind of what we constitute as 100 units and higher. On the apartment front, you may look at other reports, and when they factor in, 8-unit, 10-unit deals, can be a higher number, but it's about $3 billion. Last year was just at that number. I think there was about 38 transactions. Year to date, we're at $2.5 billion. I think there's about 35 deals that are traded or are about to trade. But between now and let's say the end of September, there's going to be $1 billion worth of product coming to the market. So I think the appetite for being in South Florida is still there. It continues to grow. I don't think the pricing is scaring folks away. I think they are still underwriting to the same return metrics. What we usually see is more on the deal size, is kind of where you can kind of see the activity. So what we kind of call the mid-level $50 to $65 million deals, you're going to see high bid activity. Once you get kind of to 75 million to 100, it'll drop down a little bit, and then $100 million and higher, you're dealing with a handful of folks. And it doesn't really have to do with the price per unit, it just more has to do with the size of the equity check that these folks are comfortable with.
What about long-term holders? I actually read an article you published in, I don't know if it was South Florida Business Journal or one of them, where you mentioned historically South Florida has been a long-term holders market, but recently they've been trading. The groups that are buying today, are most of them long-term holders, or are most of them fix and flip groups?
I think that they are they're underwriting, anywhere from a 5 to a 10-year hold, depending on the asset. But to Michael's point, there's more and more people moving down here daily. There's more jobs being created. Unemployment rate is low, and they're able to kind of hit those returns because they're selling that value-add dream to somebody down the road, and they're able to exit, a couple of years early. So I think that's what you're seeing. I think they're not banking on it, but that's kind of the market we're in right now, and they're able to hit that.
Is Mike and Denny, is that something that you agree with, or are you seeing that a lot of the investors are family offices that are looking for long-term holds, or a lot of them kind of these 5 to 10-year holders?
I mean, just traditionally, South Florida's been, it's a very liquid market when you go to sell, but there's not a ton of turnover in transactions. So I never meet any group who wants to buy apartments in South Florida who says, I have too many of those. They're always looking for more transactions. So what we find is when groups own a property, they're going to end up holding it a little bit longer because to sell out of it and then go back in at the same yield or a lower yield or so on is a lot harder proposition for them. So I think everyone goes in, I would agree wholeheartedly, it's a 5 to 10 year kind of underwriting. The exception is when the markets are running or if they find another opportunity, they may trade out a little bit earlier than their hold period.
Got it. Denny, you wear a lot of different hats in the industry. You're a developer, you're an owner, you're a broker. Tell us a little bit about how you've personally been investing over the last few years, where you've been investing and what kind of product type.
Yeah, so I mean, a lot of that happened by accident, but just in the nature of what we do every day, we get approached by clients who have a piece of land or who aren't one of the big 5 to 10 developers in the region, and so may need some help with balance sheets or others. So just over the last, probably 8 to 9 years, what we found is there are niche opportunities. Again, the major developers down here are usually buying land that's entitled, ready to go. They want to deploy it really quickly. What we've generally been involved with on the kind of development ownership side is where we find something that might have to be taken through the entitlement process. We understand we're in the capital markets every day raising money for clients, whether it's debt or equity or doing investment sales. So we understand the locations and kind of where risk can be taken and maybe where we shouldn't take risks. So where we've been the most involved is in taking those niche opportunities that aren't appealing to one of the top 10 developers or 12 developers or 5 developers and literally taking some risk and taking it through the entitlement process. And some of that we've sold at the end of that, some of that we've deployed and developed and just held on to. I mean, as Michael said, and Noah, you said, it's really hard down here. It's hard to buy. It's hard to find good deals. So we're having, where we see an opportunity is where you can manufacture sites or add value through the entitlement process, and that's what we've been really focused on.
Denny, I know you're a modest guy, but I think it'd be beneficial for everyone to hear the sites or projects that you have developed, because some of them have been some pretty big projects.
Yeah, so we're developing one right now in downtown Fort Lauderdale. It's on the river. It had an existing parking garage and an office building, so we basically bought that. Parking is always the least valuable thing you add to an apartment project. You have to have it, but no one ever really pays you for it. You just get, you either can't rent it because you don't have enough parking or the tenants are upset. So we saw value in the parking garage and the site, so we bought that, basically got it entitled for a 260-unit apartment building, and then we have some excess parking that we can, in an urban environment, where we can continue to kind of rent those spaces on a monthly basis or transient basis. We're finishing up, we just finished a project late last year in downtown Delray. That was a block south of Atlantic. We assembled 3 sites. It took us literally 2 years, and we redesigned the project 3 times to get it approved. So really complicated and painful along the way, but it's hard to find sites in downtown Delray, so that's one. We're finishing 2 others in Boca right now in their Vita Park of Commerce, and those are niche projects. I mean, one's a 90-unit townhouse rental deal, and one's a 180-unit kind of garden style deal.
This question is really for Mike and Denny. Mike, we'll start with you. Right now, I think a lot of people, as they've not been able to purchase as much as they'd like to, they've focused inward and say, how do we become the best owners, the best managers, the best operators? What's something that Grand Peaks has done or you have done that has really differentiated yourself? And how are owners, whether they're small private owners or large institutional owners, able to differentiate themselves as owners and managers in today's market?
So I think a few things we take for granted. Sometimes are the style of a community. So I think we've taken a few risks the last few years that have paid off well for us. One example is the Rio property just south of Doral. We decided we wanted to make this property a little bit trendier by going ahead and putting up 50-foot art murals. Wynwood is a neighborhood of South Florida that's gotten a lot of attraction. People like going out there, but where are the people that are coming from to go out there? A lot of them are coming from Kendall or Doral or the suburbs, and we wanted to offer something out there that was a little bit more stylistic. So on each of the 8 residential buildings we have, we commissioned artists to put up 50-foot tall murals in each building, and took a building that had been a stale, beigeish pink community and painted the buildings white and gray, gave artists a blank canvas, and then commissioned 50-foot pieces on the building. And I think we've had great success at that project by bringing in a newer, younger demographic. Even some FIU students have started moving to a property that typically had an older demographic because of what we've stylistically done. Another property, we purchased a promenade at Wyndham Lakes earlier this year in the Coral Springs submarket. At that property, we wanted to really reinvest in the community. And when we thought about spending $88 million buying a property, we wanted to do certain things to try to make the property more special. And we said, if we're spending this much money to buy the property, what is it, an extra few $1 million to really make it nice at the end of the day? So we're doing a $7 million renovation there. And one part of that is taking our leasing office, and we hired a restaurant designer. He typically works in restaurants and boutique hotels, and spent about $500,000 remodeling our leasing office and fitness center, trying to make that as nice as it would be as if you were walking into this hotel. So I think at the end of the day, we'd rather have a 2 or 3% higher cost basis in the deal, but have spent the money well. Doing things like putting in a side-by-side refrigerator freezer. Yes, it's $300 more expensive than a standard 18 cubic foot refrigerator, but we think at the end of the day, the families that are living with us, they notice that appliance. They use it 10 times a day, and they're willing to pay a little bit of a premium for those features.
Got it. Anyone else on the panel want to mention on anything, again, unique or interesting that you've seen, that you've done, that really differentiate yourself from a management perspective or an ownership perspective? Okay, we can take Mike's ideas. Denny, let's talk about equity for a second. Obviously, there's a flood of equity in the market. Everyone sees that and knows that. But I want to talk about where the equity is coming from, and if there's been a shift of equity over the last few months or years. Has there been a consolidation of equity? Is equity still spread across multiple different groups? What are you seeing?
So, I'll just divide equity into two different categories, one sort of on the buy side and one sort of on the development side. On the buy side, we definitely, I would tell you, multifamily in general, since I started my career 20 plus years ago, where it was a really fragmented kind of sector of real estate. It wasn't even a very acceptable institutional kind of asset class to go into. It wasn't one of the big four. It's changed now. It's very institutional. All the institutions want it. And we've seen sort of this wave of just the largest owners of multifamily in general across the country is really consolidated into a lot. So as Zach was saying, on these big deals where you see really a handful of groups are competing, it's those same kind of groups that own a large majority of the units. So I think equity on the buy side is really consolidated. At the same time, some of those institutions that are some of the biggest owners are getting their money in different places. So for a while it was domestic pension funds. What we see today is a wave of foreign capital, and everybody talks about foreign capital, and everybody's looking for the foreign capital solution, and some of them think it's dumb capital. But where we see foreign capital play a big role right now is it's coming through those same advisors. So if you take the Invescos and the Heitmans and the JP Morgans and all these core kind of or other types of strategy funds, the foreign capital is not coming direct to Zach or myself and buying a deal, but it is coming through those advisors, and that's kept the kind of liquidity in the market. It's kept the appetite for buying.
Chad, I'm interested in knowing, I think the audience would be curious to know, where's most of the equity coming on the deals that you're seeing that you're doing debt on? Is it coming from institutional groups, as Denny was mentioned, or foreign capital, or is it staying in the private side?
Well, I think to Denny's point, it's been a mixed bag. I mean, we've seen institutional capital come in, we've seen private high net worth capital. One of the things in recent, I think, that has been interesting is that you've seen players who are not traditionally real estate guys. Guys who have sold companies, may have been in the tech space, had a large amount of capital, and want to do a 1042 transaction, which is kind of similar to a 1031, and inject that capital. To Denny's point, same thing with the foreign capital. I think it's coming through some of those same managers, and you throw the Harrison Streets of the world in there, and guys like that, who essentially are chasing all the same deals. More often than not, I have to make sure that I spend time on the front side looking through our internal system, because you're seeing 2 or 3 or even sometimes more originators are looking at the same deals, and sometimes with the same capital sources, but with different operators.
Very, very interesting. I think you bring up an interesting point, which is you're seeing a lot of capital from non-real estate ventures or historically real estate groups. Zach, I know that you see most of the buyers in South Florida. How many of those are historical real estate buyers? How many of those are new groups that maybe sold a tech company or a medical company or something else?
Yeah, that's a good question. We've seen a mix. I think, I'd say probably new to real estate is on the lower percentile, but we are seeing people transition over from whether they've been industrial or office historically into the multifamily sector. We've seen a fair amount of that over the last, I'd say, 2 years, and they've been probably some of the most aggressive and active buyers on some of the deals we've sold down here.
What about the non-institutional buyers? How do they actually win deals today? Everything I'm looking at, and I know everyone here in the audience on the panel will tell you, everything gets bid up. For a non-institutional buyer, a group that has, X amount of capital and can only chase X amount of deals, how do they actually win deals in the environment that we're in?
Well, I think the easy answer is they pay more than anybody. But there's obviously everyone looks at a couple things when they, are looking at a deal. Your seller is, speed to due diligence, the willingness to possibly do something less than 30 days. Everyone says they'll do something in 30 days, but if you'll do something quicker, if you'll start from an access agreement, maybe you put up some hard money day one. It doesn't have to be all of those, but some function of that is helpful. But that's kind of the normal course. But I think for us, when we're conducting, buyer interview calls, the things we like to hear is that, ideally you've got the equity ready to go. Not, hey, we've got a couple groups and we're going to figure it out. And, well, do you have partnership docs? No, we're going to do that during due diligence. That's always kind of a red flag. It's nice to know that the key decision makers have been out to see the property. It's always comforting to hear, hey, this is fully approved, fully vetted, we're ready to go. Because some of the institutional groups, they have acquisitions guys that are flying all over the country, and once they kind of get a little nibble, then the higher ups will come down. So that just creates extra time. So if it's a competitive situation and you're a private group that's got full sign off, you got your equity ready to go, that helps. I think the last thing is unless you're financing with Denny or Chad, most of the brokerage shops have some sort of finance arm. It's very helpful that you use that group because you kind of can control the process if there's any hiccups, because you never know what's going to happen if there's going to be some sort of delay. That you can control and tell the seller, hey, look, they're going to need an extra 15 days because the PCA is delayed, whatever it may be. That's beneficial as well.
Got it. So it sounds like certainty is a big item. This just came into my mind, and I hope it hasn't happened to you. It probably hasn't, but I hear other places deals get dropped because these groups, as you mentioned, are all over the place and bidding on 100 deals at once. For you and for Denny, what percentage of, do you think, deals in today's market are being dropped just because they don't have the equity lined up, they didn't fully vet it during their brief due diligence? Is it 50%? Is it 10%?
I'd say it's probably less than 10%. It happens to everybody. But sometimes you have a flyer that's way out ahead of some groups on the bidding, and the seller's willing to take a chance. But you do the education, but you're always kind of keeping those backup groups warm, and talking to them, making sure they're still interested. But I'd say the deals we've worked on, I'd probably say it's a little less than 10% that are dropping a deal.
Denny, is that pretty consistent with what you're saying?
Yeah, well, I know it never happens to Zach, so.
I don't make it feel bad.
I think that's why it's so hard for private groups to buy deals, right? I mean, through our process or Zach's or, any of our other competitors, right? I mean, we're running a very tight, competitive process. So at the end, even for a little bit of money sometimes, our sellers are going to choose that certainty or groups that they've transacted with before, or things that make them, real estate's a small world, so usually sometimes there's a relationship between firms. Those are all things that kind of sellers are really looking for, because it is so competitive, because cap rates are low, because pricing is high. No one wants to take that risk. Sometimes you do take a flyer, but I'd say that's really rare in the scheme of most deals. Groups will choose that certainty and make sure it gets closed, because you never know what the world looks like 60 days from now or 90 days from now. And so when groups decide they're going to sell and the price is right, they want to close as quickly as possible. So it happens, but it's usually, it is pretty rare, I would say. And it's usually for some other reason, a physical issue that came up that wasn't known or identified up front.
Mike, have you had to go outside of your comfort zone at all, whether it be hard money or short due diligence in order to win a deal that you really wanted?
At times, I think you just really need to have your equity partners on board with you when you're going in to bid on something. And I think we've been able to deliver certainty when we're buying properties. So in rare circumstances for a 1031 exchange, we have offered hard money at contract. But I think of the last 6 deals we've done, we bought every one at the exact purchase price that we put on the LOI. We close on time. We understand that if we find something due diligence, it's a couple $100,000, we typically can eat that. We have that in our construction budget, that we want to win deals on reputation, and I think that that matters a lot at the end of the day.
Chad, what about from your perspective? You know, and again, I know it's a sore subject to talk about, obviously, but deals that you're working on, where they've already brought in a lender, what percentage of those deals end up not happening because of an unforeseen circumstance, or they didn't have their equity raised, or they can't get the debt maybe that they underwrote?
Yeah, I mean, I think you're seeing it a lot, or I won't say a lot. You know, we're seeing it a fair amount, and I think it happens in markets where, I think I was talking with someone in the audience earlier about this, and, you know, markets where growth has kind of traditionally been flat, you know, your secondary, your Baton Rouges of the world, you know, your Spring Lake, North Carolinas of the world, you know, markets where the agencies are going to go to those secondary and tertiary markets. You know, you're seeing some instances where the underwriting was a little aggressive, and, you know, you have sponsors who you transacted with before. I mean, look, don't get me wrong. I love to do deals with all of you, and I hope to do all of your deals, but I know I'm not going to. But, you know, you have sponsors who are coming back to you and say, hey, look, we want to fact check these numbers. You know, we know we're a little aggressive. We've got a business plan in place we think we can execute on. You know, we've done this in a similar space, so we're confident that we can deliver, but we want to get a second set of eyes on this. I think you do have a lot of sponsors that are doing that now because, you know, as the landscape continues to change and, you know, like Michael said, as cap rates continue to compress and you are forced to close quickly, I think one thing to also add to that is that, you know, you're now seeing the growth of quick close lenders who are just saying, hey, look, you know, we'll give you the money, go ahead and close in 10 or 15 days, but you can come back and take me out. So you have sponsors who, you know, like Michael said, you want to win a deal on your reputation, so you may not want to put hard money down for that, but you'll go through that lender to get a quick close and then come back and put agency debt on the property.
Got it. Let's go back to South Florida for a moment, because I know a lot of you are South Floridians in here. Zach, not to give away any buyer secrets, but are there any pockets that you're starting to see growth in? You know, obviously the Windwoods have grown, and Doral has been growing for the last 5 years, but new pockets that maybe surprise people to know that buyers are going into?
Well, let's start high level for a second. I think from a class perspective, what we're starting to see is, you know, Michael, we talked about the bidding activity, and the bidding activity on the value add space is, you know, for lack of a better word, insane. You know, we just closed a deal over by where Michael bought by FIU, and it was a $60 million deal, and we had 45 offers. And I think between the initial bid to where we ended up, pricing moved 10%. So, you know, you're one of those 45 bidders, that's a low probability that you're going to be successful. And so we're starting to see some folks kind of branch out of just the value add and look at more of the core plus space down here. So kind of that 2010 vintage and newer, where maybe that was coming out of the cycle and, you know, the finish levels were not as nice as what you're seeing now. You're able to go in, you got great bones, 9-foot ceilings, and do a renovation program. We sold Michael a deal in Plantation when he went through that program. I think he's been seeing great success. But as far as pockets where I think they're, you know, we're going to see some growth potentially, where it's been overlooked in the past is, you know, maybe the northern Broward corridor, kind of that Tamarack and Pompano area. There's a lot going on kind of on the East Coast in Pompano. They put a lot of money into their boardwalk, and it's kind of expanding out west. There's a ton of office in the Cypress Creek corridor there, 6.5 million square feet. There's been a bunch of single-family homes built over there. So the demographics over there are definitely starting to pick up, and you're starting to see folks that want to live closer to where they work. So I would say kind of that northern Broward pocket is one area where you may see some opportunity. The other one that always shows up on every, you know, market report that you read about, but is really only kind of a private niche market down here, is kind of that what I call Northwest Miami-Dade, kind of Hialeahs of the world. If you look at their trends, they're always 99% full and have some of the strongest rent growth in all of Florida. And if the mall takes off over there, I think you're going to see a ton of employment. So, that's another area that may circle on kind of the map and start to pick around for some opportunities if they spring out.
Speaking of opportunities, you want to ask me?
No, I was just going to add a point. We actually, that's a good point that Zach made. We actually just rate locked a deal over in Hialeah for a client who self-performed, was a developer. Quite an interesting story. Could have done a $7 or $8 million deal, but just low leverage guys. I want to say the transaction was probably 57% loan to value. Was willing to be at a 135 debt cover, which further limited the proceeds a little bit. And it actually went into the realm of being in that below $5 million range. And the client was actually looking at debating between a Freddie Mac small balance and just a conventional agency loan. And for the better part of the transaction, we thought we were going to go the Freddie Mac small balance route, but ended up flipping it, Fannie conventional. We were willing to get a little aggressive. We went into Fannie and pushed them. And on that transaction, we ended up doing a 15-year term, 15 years full-term IO, and they locked that transaction yesterday at about $495.
Unbelievable.
I'm sorry, that was in Hialeah.
Yeah, no, that's interesting. It's my understanding of Hialeah, and for whatever it's worth, has been it's been long-term holders. It's privately owned, family owned, and to Zach's point, if you start to see institutions go there, it'll be interesting how quickly people follow. So that's definitely an area to watch if you're a South Floridian. Now, I want to talk about opportunity zones because that's obviously been on the minds of everybody. I get a call on it every 2 days since the tax code changed. Denny, I believe that you have a good understanding of the opportunity zones and you're even working on one now. Can you talk about it a little bit?
I wouldn't say I have a good understanding, but I'm not an accountant. So we are working on a deal right now where we're raising debt, construction loan debt, and equity for a deal that happens to be in an opportunity zone. And it really, we started this deal, we've been involved in it for a while, and engaged by the developer and their equity partner. And then when the tax code changed, it sort of turned our whole kind of approach to raising the equity side of it. So, really the key to the opportunity zones, again, I'll just give a disclaimer, check with your accountants, right? Because don't take my word for it. But the real key is it's a way to roll $1031 into a deal, and as long as you hold it at certain periods of time, 5, 7, 10, you don't have to basically pay taxes on the gains versus kind of doing a 1031, rolling into another 1031, rolling into another 1031. The key is there's pretty set timeframes on this, so end of 2019 and end of 2020, you got to kind of place it. There's other nuances around the opportunity zone kind of language, and this is where you really got to get into the weeds with your accountant and your attorneys, is in terms of what, does it have to be a separate entity? Can it be in a fund, or does it need to be a separate entity that you're selling and still comply? So with the way we're seeing, there's a lot of opportunity funds that are starting to kind of ramp up and go in, but the way we see those dollars being deployed right now is literally kind of a new opportunity fund that's its own entity set for each specific deal. And that seems to be the way groups have gotten most comfortable with it. But in this deal, where normally we're out talking to one equity provider, an institutional equity provider, or opportunity funds, not opportunity funds, but opportunistic investor funds. In this deal, we ended up kind of piecing it together. We involved our New York office, which has a lot of high net worth money coming out of the Northeast to South Florida, and we pieced it together, across 3 to 5 investors for the equity piece.
I'm interested, just a show of hands in the audience, how many of you guys have either started to look at deals and opportunity zones or have had, lenders or buyers come to you and question it? Okay. About 30 or 40%. Yeah, this is something that's brand new, so for the fact that 30 or 40% and it's already looking at it, this is something that I think will become more robust. Chad, I want to talk about financing for a little bit. It's always an interesting topic. Just give us an overview on what's going on with your clients. Are they still going to typical agency executions, Freddie and Fannie? Are some starting to have to get a little more creative, whether it be preferred equity, mezz, or another creative financing source?
Yeah, I mean, I think it's a mix of both. Look, one, it depends on client profile, depends on your wherewithal. I think, kind of what we touched on earlier, when you have guys who are, kind of in that 500 to 1,000 unit ownership range, and they want to get to, 3,000 or 4,000 units, so they may not be ready for the institutional sphere. I think those guys are having to seek out, some either, whether it be alternative sources, whether it be alternative partners, or some type of pref equity piece, or look, it could just be traditional agency, and they say, hey, look, we're going to bring in a couple more partners than we thought. As for us, I mean, we're seeing it pretty much every quote I get. We got approval a little while back to put mezz behind our Fannie loans, hunt mezz that is, and so pretty much every deal I'm looking at, I have guys who are requesting, hey, what's that mezz slice looking at a 105, on a blended basis. So guys are doing it, and I mean, look, it's again, I think it comes down to the business plan where guys think they can execute it, they can get in, and really drive those renovations and turn units, and using the other advantages of the agency product with green financing and all of those things as well. And just for the simple fact of me, getting on the phone and calling Fannie and say, hey, look, it's competitive out here. I need a discount to win this deal. So I think the agencies are still receptive. One of the questions that we always get are, about the lending caps with the agencies, et cetera. I mean, look, they're doing, I think, a lot more business than they expected on the uncapped space. I think that will continue. And, I think in the future, they will probably revisit the program again to, potentially slow that down a little bit. If you kind of look at kind of the macro perspective in the market as well, you've seen some higher wages come into play, but it's not necessarily translating to a lot of inflation, right? So what's going to happen in that space? I don't know. With our political climate, January is around the corner. We're going to have a new FHFA director. So that could mean some different changes for the agencies as well. One can only speculate, but if I had to shake whatever crystal ball under the chair here, I don't know. Someone here may know a little better than me, but I would expect to see probably a little more of a conservative take on it. But I think that can also come with retooling kind of the way the agencies are looking at some of those deals.
You mentioned something interesting, which is mezz behind Fannie. I know that I'm sure whoever here has tried to either do preferred equity as an owner or as a lender, put preferred equity on top of agencies. Everyone knows Fannie's been a little bit more difficult. Tell us a little bit about what the mezz behind Fannie actually looks like.
Yeah, well, I mean, it's just our own hunt mezz, and I mean, we're going to price it out. You have to be on a blended basis of a 105 debt cover. And I mean, that's pretty much it. It's not, not anything that's some big secret sauce. It's just, straight up deal. I mean, every deal is going to be coverage constrained right now. So, when you look at that blended basis, it's, how much more you're really going to squeeze out of the limit. I'd say every transaction that I'm looking at, it's probably no more than, $1 million to $1.5 million plus tops. So if I'm talking, standard, call it, say, $8 to $12 million transaction.
Understood. So we're actually doing something very similar. We have a pretty robust preferred equity program. I know that, Chad, about it. We talked about it a lot, where we're one of the only groups actually doing preferred equity, a little bit larger than that, behind Fannie. We've been doing it behind Fannie since 2011, and it's gotten a lot tougher, that's for sure, and a lot of groups aren't even touching pref behind Fannie because of their strict regulations. For us, it comes down to sponsorship. At this point in the cycle, we really want to make sure that we're partnered with sponsors who we really believe in long term. That helps us get very, very comfortable. Tell me a little bit about what's going on. Sure.
The preference you're structuring behind Fannie, what is the term and how are you structuring it to fit their model?
Sure, well, I'll let Chad speak for his group, but at Pensam, the typical term is usually 3 years with a couple extensions. We've selectively gone out a little longer, but we'd like to be paid back within figure 5 years. I don't know if you want to mention your term.
Yeah, and I was gonna say, we're typically looking for the same thing, because it actually comes from my investment management, so they're looking for kind of the same thing, 3 years, but because, you know, we also are owner operators, developers with other companies, and a lender, we're actually willing to look at and run with the term of the loan.
What about bridge debt? Bridge debt has obviously exploded over the last year. I heard a statistic recently, I don't know if it's true or not, someone told me that year to date, there's 100 new bridge lenders in the market. Now, I don't know if it's actually 100, I don't know if it's 50 or if it's 200. It sure feels like it's at least 100. You know, what has changed in the space over the last year? How aggressive are groups getting?
Man, well, first I'd like to show of hands, how many bridge lenders in the room right now? Or who do some type of bridge lending capacity, so there you go right there. I mean, look, we're friends and competitors here, right? You know, I would say with the bridge space, it kind of breaks down again, one by, you know, I'd say both asset class and lift, right? You know, who's going to be, I don't know, who's aggressive right now doing a, you know, 75%, you know, 80% bridge on retail? Not us, I'll be the first to tell you that. Obviously, we like the multi stuff, but yeah, I mean, look, you're seeing bridge lenders come into the space. I'm seeing it from a couple different fronts. You have the guys who are looking for, you know, sponsors who may not be bankable, you know, who may have had a bankruptcy or, you know, some other type of issue or lawsuit, whether it was a fallout with a partner, and, you know, they're going to go out and get 7, 8, or 9% money. And, you know, that may be in a higher growth market in, you know, the East Coast or the West Coast or something like that. They know they're going to perform on a deal. Then you also have the, you know, the bridge lenders in the space that are in my realm. You know, we're, in the multifamily space, you know, we're 80% loan to cost, you know, L plus 350 group. You know, seeing guys go into the L3, I'd say 300 to 400 is pretty standard now. And some of my counterparts in here, I know that, you know, I know they're going up to 90% loan costs in the bridge space as well. I mean, look, we've looked at that as well. We're tackling some type of, you know, maybe a partial recourse on, you know, 10 or 15% of that behind it. I mean, look, again, I think it goes back to being, again, sponsor specific, market specific. You know, I'm probably not going to push to do an 85, you know, 90% bridge in, you know, secondary, tertiary market where rents have been historically flat. You're telling me just because the property is 78% occupied, you're a great operator, that it's going to be better.
There are groups doing it.
There are groups doing it. There are groups doing it.
And Denny, does that worry you? Groups that are going up to 90% in the bridge space now?
Well, it depends on if I'm working for my clients or not. So, I mean, look, multifamily's got a lot of tailwinds behind it, right? I mean, pricing has obviously been pretty aggressive. Rents have grown. So, I mean, I think, again, as a lender, and it's been mentioned a couple of times up here, and I hear it every day in my day-to-day business in terms of when I'm, you know, out for debt for our clients. I mean, it's very sponsor specific. I mean, every loan, whether it's a 65% loan or going up to 90%, is very sponsor specific. And we're seeing a lot more attention, especially for the higher leverage kind of stuff that we're working on, paid to the balance sheets, liquidity and net worth. So I think it, you know, it's market specific, it's sponsor specific. I'm not overly concerned with it. I mean, it's risk-based capital. As long as Freddie and Fannie keep doing what they've been doing, which provides a lot of liquidity on takeouts of this stuff, I think it's still in pretty good shape right now.
What are you seeing in the construction debt market? I know you do a lot of construction debt.
Yeah, so the construction markets, I mean, have not been extremely robust this whole cycle, and they haven't really gotten much better. They've gotten a little better. So we see sort of a tale of kind of two cities in that world. If you're one of those great sponsors and you had a relationship with one of the big banks and you maintain that relationship through the downturn, those doors are open and the bucket is open and they just keep relending and relending to the same kind of handful of relationships they had. And that market's really competitive and you get cheap debt and you pay off one loan and they'll relend it back to you for the second loan. The other side of that coin is if you're new and you don't have a relationship with one of those, 5, 6 big banks, then those doors are really closed. I mean, they're reserving all their construction lending capacity for those kind of handful of clients. So you're having to piece it together in a different way. Where we see a lot of competition being created is in the sort of smaller regional community banks who can't do, $50 million loan, but 20 to 30 million could possibly get done. And those guys are starved for multifamily loans. And so there's a lot of opportunity with them, but deal sizes in South Florida in particular just kind of climb. So it's really hard to find deals that kind of fit that bucket. Outside of that, there's plenty of debt funds that have a ton of construction loan money, and that's where a lot of it's getting filled right now.
Sure.
To this point, the other thing that you see with those few developers who can go to these banks and can borrow a lot of money to build, what they're doing is they're changing their guarantee structure over the last 2 to 3 years to be less individual-based and more entity-based. And so the banks that are providing that capital are taking a little heartburn on that. So you've got these huge contingent liabilities associated with entities versus individuals. So those players will look for alternative sources because the banks are underwriting them a little differently than they used to when they had the individuals versus these entities. So even those players are looking outside of their traditional bank for construction finance.
I like you. You're on my panel next year. No, you make a very good point. And I appreciate you trying to get into that. Is that something that you're seeing pretty much throughout the market as well?
Yeah, I mean, I think for this whole cycle, construction loans have been iffy, right? For whether you're a tried and true developer or not, you just never know what's going to happen when you go out to the market for that particular loan. So I think whether you're building 50,000 units across the country or you're building one deal, groups are talking to whoever they can because they're not sure how that piece is going to get filled and where the most competitive kind of rate is. I mean, I will tell you spreads for those great balance sheet, great sponsors have been very consistent through this whole cycle. We haven't seen them move hardly at all. But again, it's just getting the doors open to get that.
Mike, tell us a little about how Grand Peaks capitalizes their deals.
So I think in general, tend to be much more conservative than other people playing in this marketplace. We benefit from having some very strong relationships with equity investors in our deals that are state pension funds, big corporate pension funds, that are big insurance companies, as well as a few high net worth billionaire families. And those groups don't want to be over levered, and I think what we like is having staying power with those type of investment partners. We're not necessarily going out and underwriting how can I get a 18 or 20 IRR, layering on mezz and flipping this deal in 2 or 3 years. We like to have the flexibility that if we can sell a deal profitably in 3 years, we will, but we tend to be more of a 5 to 10 to 15-year holder. And I think a lot of these pension funds are saying, I'm happy going out and buying a deal for a 10 or a 12 IRR over 5 or 7 years, underwriting it with 50 to 70% leverage. So we closed a deal earlier this year at 50% leverage, plus we had a line of credit to be able to draw down another $7 million for renovation, still being under 60% loan to cost. And on that deal, it priced at 125 over the 30-day LIBOR. So how can we pay a low 4 cap per deal? Well, we have debt in the low 3s. So we're able to go implement our value add plan, get yields up into the 5s, and have, even if rates were to move 100 basis points, we're still better than if we had locked in a fixed rate loan today.
Mike, I wanted to speak about something that I think a lot of people in the industry don't focus on, which is unique to South Florida, which is the condo market. Clearly, you look at an area like Brickell or downtown, most renters are renting from private owners from the condo market. I know you have a lot of experience in the condo market. Tell us a little about what's happening in the South Florida condo market, how that will affect multifamily down here.
So I think for Grand Peaks, our portfolio is in the suburbs. It's not affected by 500-unit high-rises that are trying to get $3 a foot rents. Maybe those developers only get $2.60 rents, and that they don't find the profits that they'd hope to find in the deals. So I think that the general multifamily market, even though the condos get the headlines, is mostly unaffected. Though I do think in Brickell it's very unique, where being an owner in a high-rise a few blocks from here, 70% of my neighbors are renters. They're renting in a very fractured market that's really unique to South Florida. I do think there's arbitrage in the condo market, people coming in and buying today. I was able to buy a 3-bedroom condo over the summer from a bank that had foreclosed and bought it for under $300,000 for a 3-bedroom condo on a 30th floor of a building built a decade ago. So I think there's definitely cracks in the condo market, but I still think when you're going out and buying these condos, you're not buying them at such a low basis that you can instantly have it be profitable. I started buying condos, I bought a dozen of them starting in 2011. I was working equity residential, buying very big deals. On the side, I was buying a bunch of condos personally. And there was a time here when you could buy condos for 50% of construction costs. I said, the rental market's doing great, you can fill these things up. When you look at some of the currency concerns, people have taken money to Miami out of Columbia, out of some of these buildings, and you said, why did they pay $500 a foot to be in this building? Maybe they have to sell the property if they want to liquidate today at $450 a foot, even $400 a foot. But if you look at what their currency did back in their home country, it was actually still a good trade to get their money into dollars for a period of time and then repatriate it at current exchange rates. It would have been a profitable trade for them. And I think more than anything, over the next 20-year history of Miami, we're that much better of a city for the people who have taken the risk and bet on building these condos. And if you look at REITs that are paying you a 3% dividend, I think some people sleep well at night saying, hey, I own a few condos, they're yielding me 3 or 4%, but I can liquidate them when I want, I can refinance them when I want, and I'm not owning part of a bigger corporation that's still paying me very low yields.
Mike, the condo that you just purchased that you mentioned, the 3-bedroom for under $300,000, I mean, I think a lot of people in this room, are shocked when they hear that price. Is that something that's normal in this market right now, or that's something you would dig for?
I don't think it's normal. I think people need to spend time looking for deals. That's part of what I like about real estate, even in the commercial real estate space. It's not a stock. We're not going to the internet choosing if we want to buy Apple or Google today. You're dealing with personalities. You're negotiating with personalities, and you have to find people who have unique motivations to sell. And if you spend the extra time doing that, fostering those relationships, you can do better on the single family side. You can equally have fruitful relationships when it comes to buying a deal that's been dropped twice and you're going and buying a $40 million deal, but because of your relationships, you're able to go in and cut a deal at a price lower than what the 2 previous buyers have been trying to pay for it because the sellers become motivated and want to liquidate.
Having worked with Michael, I can tell you he likes to find deals. So.
I just want to add one thing to the downtown supply as far as kind of the shadow market, because it's a question that we get all the time. We've been getting it for the last 10 years. And I was one of those shadow renters. I think that we've seen, there's still obviously, you're always going to be fighting it, but I think we've seen some transition to the existing rental product that's been delivered, because if you go through the new high-rises that have been built downtown, the execution the quality levels is on par with what those condo levels are now, the amenities they offer, the finish levels. And I think what some of the renters are finding is if you rent from Michael, he's going to want first month, last month, and a security deposit. You're shelling out 10 grand before you even step foot into that apartment. On top of that, if something goes wrong, with your AC unit, you're trying to find Michael, who's trying to find someone to come fix it versus calling down to the front desk at, one of the high-rise apartment deals, and they're sending the maintenance guy up, and you might be, have it fixed in 30 minutes versus 3 days. So, from talking to those developers, I think the absorption is what they expected, but, they're always still going to be battling some of that shadow supply.
I'll just add to that. I mean, look, Miami's a unique city in a lot of ways, and it definitely, the condo battles these apartments, but it's also kind of what we're seeing as a maturity just in the U.S. and a lot of these kind of big cities like this. I mean, if you go to any big city in Europe where there's not a ready-made institutional apartment market, right? The majority of the renters are renting condos that are owned, right? It's just part and parcel of how you rent and where housing is provided. And in Europe, there's for cities that are huge and have been around a long time. So the difference is in Miami, we have a ready-made institutional apartment business where people, developers put up 300 for rent purpose apartments. So it's a part of the inventory, it's a part of the rental supply, and just, it competes in the market. I agree with Zach. I mean, it's not the same as an institutionally run apartment project, but there's enough people here, there's enough people coming here, so just the same supply-demand kind of balance you gotta watch.
We're running low on time. I want to see if there are any audience questions. Okay, if not, there's one last question I'd like to ask everybody just about 2019, quickly. For those waiting on the sidelines, that have been waiting for the last year or 2 years and think that there will be some sort of shakeup, will there be a shakeup? Do you wait it out, or do you jump in now?
So I look back at our existing portfolio. We bought a deal from Zach 3 years ago called Solera Plantation. We've been renovating the deal for the past 3 years. If I look at our last 50 renewal leases, going back to July 1st until today, the average rent increase on somebody who chose to stay with us for another year is 3.8%. I'm seeing that type of performance across our portfolio. There's real demand, there's not a plague, people are continuing to move here, they need housing, and I don't see anything, as I'm looking across our portfolio, that would indicate that rents are going to be any lower next year because of the demand we have today.
I was sitting out in the panel, or sitting out in the audience when Ron Terwilliger was interviewed about a year ago, and someone asked about what inning we're in, and he said he'd been through 4 or 5 cycles in his career and never once was able to determine when we were going into a downturn. So I would say if a deal makes sense, it hits what you're looking for, you need to jump in and do it.
I mean, I echo all those same sentiments. If I had the crystal ball, to be honest, guys, I probably wouldn't be sitting here. I'd probably be on a boat somewhere, sailing in an ocean. But I mean, look, I think fundamentals are still solid. Yeah, credits maybe loosened in a few places where I think it's warranted. You still have markets that are getting some growth. Like Michael said, when you look at rent growth, and you also look at migration patterns across the country. You're continuing to see folks leave the Northeast and even some of the Midwest and the Chicagos of the world, and they're coming here, and they're going to the Texases of the world where there's no state taxes and et cetera, and you can have a better quality of life, and I mean, not to be cliche, but you can live, work, and play, and do it in a place like South Florida. So we continue to see demand, and we continue to see the new markets opening up, the little Havanas, the little Haveys, the Hialeahs, and on up the East Coast to the Pompanos and Del Reyes as well. So I think there'll be continued growth.
Yeah, I mean, look, if you're waiting for like a great buying opportunity, I promise you there's billions of dollars just sitting there waiting for that same opportunity. So even if there is a great buying opportunity because of circumstances, it's going to seem just as competitive that day when you're trying to buy it. So you have to pick your locations, look at the demand fundamentals, and if the return works for you, you jump in. It's been a great product type. It's proven over the last 20 years to be pretty stable. Don't over leverage, and plan on holding, and you're great.
Perfect. Mike, Zach, Chad, Denny, thank you guys so much. Thank you all for attending. We appreciate it.